We're winding down Q2 earnings here. For the most part, revenues were a miss, but EPS still beat on cost reductions. Sam, what does this mean for the third quarter earnings estimates that are out there, and will management be able to beat them handily?
Well, I think the bar is being set pretty low to start on the third quarter. When we began the first quarter reporting season, the expectation was only for a 1% gain, but we ended up with a 7.5% gain. Along the way, however, we stole from estimates for the rest of the year. We thought we would see much better results in the second quarter. Then we came out and it was like, no, maybe we'll see a 1% decline. We've ended up now with something that's closer to a 1% advance, but still nothing to write home about. So earnings deceleration is still definitely in force. And one reason is because revenues, which were expected to be up about 5.5%, rose only about 2%. So possibly because of share repurchase programs, companies were able to at least have some positive earnings in the second quarter. But for the third quarter, rather than getting close to a 2% gain, now it's possible we're going to see a 2% decline year over year. So, you could say, well, they're just setting the bar low again so that they can beat once again. But again, the deceleration is something that's quite evident.
So far this year, year to date, the stock market's up 13%, and since the October low, it's up 29%. So where do you see the S&P ending the year?
Our estimate is we have a 12-month forecast of 1,500 on the S&P. So when you sort of annualize that out, around the mid-1400s. And that number is actually fairly consistent not only with technicals, but history would confirm that since World War II, we have had 14 times that the market suffered through a severe correction or a mild bear market, but we were up an average 32% 12 months later, which points to about a 1450 level by early October. So again, possibly 1450 to 1500 or more is what history says could happen.
Would you expect a pullback before we get there? Because we do have the election, the fiscal cliff. Europe is still out there as a concern.
The bearish argument, I think, is the most sane argument right now. You can come up with all the reasons why things are not going to do very well. But at the same time, Wall Street participants are opportunists. They're going to be getting in whenever there is an opportunity to do so. I also like to say that they're no better than hyperactive first graders playing musical chairs, always trying to out-anticipate the other. So with that in mind, while most people would expect a pullback of some sort, yeah, you'll probably get a pretty quick digestion of these recent gains, but you're not going to have it be meaningful enough that's going to allow people to say, now it's time for me to go in. I think most people are going to cut it short and get in sooner than most people would prefer.
This market has fewer players.
We're coming into a Monday where we're
entering a new stage of tech.
It's a stock picker's market.
Welcome to the 5 dumbest things.
Apple reported earnings